Financial Crimes and the 2008-09 Financial Crisis. Module 6, Part 2 of the readings. Leading up, or almost as a dry run for many of the debates on the financial crisis, was the savings and loan debacle of the 1980s. There you had, driven by savings and loans, which had been losing money throughout the late 70s as interest rates went up and the fixed rates that the savings and loans had became often worthless. This led to large-scale deregulation of the savings and loans in early 1980s. The new rules allowed lower capital requirements, especially for new savings and loans. What this translated into a $2 million investment in a savings and loan could, through multiple loans, loaning on the same capital, up to $1.3 billion in lending. This lending then moved from what had previously been mostly housing from savings and loans to high-risk investments in casinos, fast food, junk bonds, derivatives. Savings and loans, in order to increase the supposed capital they had, would buy land, resell the same property to another savings and loan, buy it back at a higher price, and then use the inflated price as collateral to do even more loans. As this bubble went up, as more and more fraudulent loans went out, as the loans went bad, when the collapse came, since many of the deposits were insured by the federal government through deposit insurance, the bailout ended up costing taxpayers more than $150 billion. Now, this was less embezzlement by the executives from the S&Ls than the S&Ls themselves being used as a weapon of fraud to rip off the public, the government, and other banks that might have lent any money to them. The enforcement actions against S&Ls were actually one of the largest scale operations against white-collar crime, possibly in American history. From October 1998 to April 1992, more than 1,100 defendants were formally charged in major cases, meaning there were losses of more than $100,000. 839 were convicted. Probably the largest scale white-collar prosecution at any period that people remember. Most famous here was Charles Keating. He owned a number of different S&Ls and was caught forging documents to cover up evidence, and had donated to 5 U.S. senators to stave off S&L regulation. He was convicted in state and federal court with 10-year and 12.5-year sentences. He did get released early based on a procedural error at trial. What passed through Congress in the wake of the S&L scandal was a new, what was called the FIRREA Act of 1989. First of all, it moved regulatory authority to what was now called the Office of Thrift Supervision in the Department of Treasury. It also required that the S&L thrifts hold at least 70% of their assets back in home mortgages or mortgage-backed securities, and more penalties were placed for institutional crimes. This was in many ways a rehearsal, or should have been, on how to deal with mounting losses, widespread crime in a financial industry. Unfortunately, that's not how it played out. When we got to the great economic meltdown that went from 2007 to 2009, nobody was in sight, the meltdown happened and almost took down the economy. It had originally been driven by subprime loans that had all sorts of conditions, cheap to get, often low interest, that had low balloon payments and other provisions that made them increasingly burdensome. Those subprime loans were made to many home buyers who just wouldn't have qualified for loans in the past. Easy terms, often interest only at first with no down payments. But with the assumption of ever escalating home prices, those assumptions were they could refinance, take on more debt, and keep the process going. But the key here was not the individual mortgages. All of these mortgages were bundled together into securities that were then collectively sold to larger financial institutions. And what were called derivatives or synthetic CDOs were complex financial instruments that would essentially slice up the risk involved in various parts of these securities and dole that out in increasingly complex, essentially bets on the housing market. And the bets were overwhelmingly that the prices would keep going up. And when those prices didn't keep going up, the financial bubble burst, homes went underwater, people lost their homes, and drove a collapsing US economy as employment across the economy collapsed. One of the earliest emblematic examples was Bear Stearns. Bear Stearns was one of the leaders in this securitization, bundling of mortgages and reselling them. And when Bear Stearns collapsed in March 2008, that was the siren that the whole house of cards was collapsing. 5 top executives at Bear Stearns had been paying themselves more than the entire roster of the Chicago Bulls the year the Bulls won the NBA championship. When the FBI searched the homes of the Bear Stearns managers, they found email that those managers knew the mortgages they were selling had become worthless. Yet they kept selling them to customers, telling them they'd keep going up in price. Pure fraud in that sense. Yet, the judge excluded the evidence as outside the scope of the warrant that had been issued, reflecting how white-collar criminals get full advantage of Fourth Amendment protections, even as most minor street-level crime ends up pleading out before they have any chance to make such a case. So, without the key evidence presented, juries acquitted the managers based on the flimsy evidence that could be presented. So that was an early chilling message that would be very hard to prosecute most of the folks who had caused the collapse. Another example was Countrywide Financial. Countrywide had been founded in 1969, but between 1982 and 2003, its stock rose 23,000%, largely based on selling massive numbers of subprime mortgages. The senior VP himself at Countrywide would say, we had a system of loans where we'd award to anyone with a pulse. In retrospect, it was long-term madness driven by short-term profit. When Countrywide collapsed, Bank of America took it over for $4 billion in the summer of 2008. The CEO of Countrywide was charged with insider trading, securities fraud, for failure to disclose the lax lending standards in annual reports, and for selling his own stock when he knew the company was in dire trouble. One internal email described the company's securities this way: in all my years in the business, I've never seen a more toxic product. The company spent $50 million on Mozillo's and other co-defendants' defense, paid for by Bank of America, and in fact, the government bailout money that it had received from the government. They ended up paying significant fines and compensation to former Countrywide shareholders, but all criminal charges ended up being dropped in 2011. So what was the broad fallout from the financial crisis? Banks were bailed out, but in fact, because the government took equity positions in a number of the bailed out banks, when the banks recovered, the federal government actually made a small profit for taxpayers overall. Additionally, 49 financial institutions paid various government agencies and private plaintiffs nearly $190 billion in fines and settlements since 2009. And possibly most importantly, the government intervention staved off what threatened to be another global Great Depression. In the wake, the government enacted Dodd-Frank to tighten regulation of the financial industry. Yeah, there remained great dissatisfaction that the financial executives who had lawlessly driven this process largely went individually unpunished. There were almost no indictments compared to the 1,000 plus involving S&Ls. Just weeks after Jamie Dimon, CEO of JP Morgan Chase, settled out of court with the Department of Justice, the bank's board of directors gave him personally a 74% raise and a salary of $20 million. So, what happened? At least at one level, saving the economy, keeping things from completely collapsing, ended up being prioritized given the costs of pursuing punishment. And it's worth remembering, in June 2009, when unemployment was still exploding, and there was the real threat of that worldwide collapse, the Attorney General, Eric Holder, wrote a worry about what he called collateral consequences from prosecution. The fear that it would drive corporate instability and collapse, and they had to take that into account when thinking about who to prosecute amongst the big financial institutions. Similarly, in 2012, Lanny Breuer, head of the DOJ's criminal division, said in a speech that the health of the company, the industry, and the markets were very important in figuring out how to file charges. Remember the worries from Enron and Arthur Andersen that prosecuting Arthur Andersen had destroyed the company, but hadn't necessarily stopped all other fraud across the industry. So there is the worry where prosecution would destroy the whole company. And it's hard not to look at the loss at Bear Stearns, where probably one of the most obvious frauds, and they couldn't convict the top executives. That helped put a freeze on Wall Street prosecutions for close to 3 years. That fear of harming innocent employees was really a very large driver, especially amidst so much unemployment in the economy. And there's the flip side. They actually were able to get quite large multi-billion-dollar compensation from the companies. And that proved far easier and with far less pushback in the courts compared to the long, painstaking work of building cases against individual defendants. Given the limited resources amongst the prosecutors, negotiating settlements yielded more headlines, more money for victims, more money for taxpayers, less risk of failure, and frankly, better statistics to impress bosses at government and potential employers in the private sector. So both private and public interest often argued for settling for cash compensation rather than going for the individual criminal prosecution. But the deeper problem may be that the corruption in the financial industry was so systematic that individual legal liability was hard to assign. Preet Bharara, the US Attorney for the Southern District of New York, made the argument that the evidence did not actually show clear misconduct in legal terms by individuals. Did Wall Street bankers make it their daily business to figure out ways to abide by the letter of the law while violating its spirit? There's some good arguments there. And as The Big Short reflects, if everyone seemed to be lying as an expected part of their job, and that was the norms of the whole industry, how do you assign individual liability? And there is the real issue that if you got the satisfaction of a few scapegoats thrown in jail, would that obscure analysis of the systematic problems in government regulation and the banking industry that had driven the problems? But there's no question the lack of individual punishment left lots of anger amongst the general public.